Mira Business FM, where business comes to talk.
The ceasefire announcement is shifting the global mood, but what does it mean for the markets that power the world economy? Oil and gas prices have been riding weeks of geopolitical tension. Investors are now asking whether this moment signals stability or is it a new phase of volatility ahead. As the founder and CEO of Neovision Wealth Management, Ryan Lamond helps investors navigate global macro trends from energy markets to geopolitical risk, and is with us this morning at Mira Business FM. Ryan, thanks for coming on.
Morning, Tim. Thanks for having me.
Good to have you here. I'd like to look, if we can, at what the ceasefire could mean for oil, for gas, and really a broader market outlook. And I'll probably fire off questions in a slightly scattergunned manner, so bear with me, forgive me. But to start with, Ryan, what was your immediate reaction from the market perspective side of you when the ceasefire announcement came through yesterday?
Well, before I talk about that, markets have been very complacent with all of the events that are happening now, and I'm sure we're going to cover that. The current energy shock is much worse than 1973's, and markets have been very complacent. Now, obviously, the announcement has been taken very positively because everyone has been waiting for this, and we've seen data Brent drop by 13 to 14%. We've seen stocks jump by 2-3% across the world. Gold has jumped to 4,850. So everyone has taken this very positively, knowing that this ceasefire seems still fragile and nothing has been signed yet.
I mean, the thing is, we've had a 10-point proposal, a much debated proposal as to which one is the right one. The ceasefire is conditional. It's 2 weeks. Markets have shifted. Oil prices have been front and center throughout the situation. Brent crude, as you point out, you're absolutely right, 13.6% down, below the 100% at the $100 mark for the first time in weeks. Does a ceasefire remove that kind of wartime premium, if you like, or are traders are still cautious, I guess?
Oh, completely. And let me give you a few numbers. If the Strait of Hormuz is open today, for the traffic to normalize across the straits, it will take 2 to 3 months, not less than that. It's not the press of a button. This is not car circulation that we're opening. It's not a road we're opening. It's actually a whole strait with lots of logistics for the traffic to normalize. Second point, all of these refineries that are shut down today across the GCC, across the Middle East, that need to be turned on again and start refining and exporting again, it will take anywhere between 4 to 6 months. So for this whole situation to normalize, it's not less than 6 months. So the gap between paper oil, or the price of oil that we're seeing on our screens, versus the actual transactional price of oil, the gap is approximately 40%. I suspect it will drop to around 30 or 25% as flows restart, but I don't see it going back to zero again anytime soon.
Ryan, a key condition, if you like, of this proposal is the reopening of the Strait of Hormuz. For global supply chains, is the physical movement of tankers, how smoothly can that normalize? As you point out, it is going to take some time. Do you think insurance premiums still act as well as a shadow kind of tax on energy?
Absolutely. Insurance premia will remain high for the foreseeable future because as I said, the ceasefire seems fragile and all of this can break down very, very quickly. And we know the insurance market is very much risk averse. And these cases, they will continue hedging the insurance policies they're rolling out. So I do suspect this will remain high, in addition to the premium of paper versus physical, and the normalization, all of these flows. So I suspect some buyers of oil will be paying a premium to be the first to get the first tanker. So this is an additional premium that we should expect. And all of this will be diffusing across the economy and across prices of products that we're going to buy every day.
To what extent do you maybe see could there be a short-term pullback in crude, or is supply tight enough to keep prices elevated?
Prices will remain elevated in my opinion, for the next 6 to 12 months. Seeing again $50 per barrel is very much far-fetched. Okay, so the paper price of oil that we see in our screens, and forgive me for saying it, I'm sure of what I'm talking about. In my opinion, it's being manipulated, kept down through multiple very complex derivatives instruments. And the actual transactional price of oil that we're seeing is between $150 and $175 at the moment, when you actually want to buy a barrel of oil. So until the situation completely normalizes, and we're absolutely sure that this war will not come back, that it's not fragile, prices of oil will remain between $80 and $120, in my opinion.
How are energy companies and energy stocks reacting compared with the commodities themselves?
Well, you've seen some of the energy company stocks have jumped substantially higher than actual paper oil prices. So this tells you something. This tells you that the paper oil prices are actually capped somehow, and the proxy, which is energy stocks, company energy stocks, has risen substantially. They're having a field day. It's the era of energy companies at the moment.
For investors watching from the sidelines, Ryan, I like how you phrase that. What signals in the oil and gas markets should they be paying attention to, in particular, over the next few weeks?
The gas market, sorry?
What signals in the oil and gas markets should investors really be paying attention to in the next couple of weeks, 3 weeks?
So I have a screen right here open dedicated to watching the traffic across the Strait of Hormuz. So serious professional investors, this is what they do. They have a screen with live tracking of tankers going through the Strait of Hormuz. As long as I don't see at least 30 to 40% of the previous traffic I used to see on the Strait of Hormuz, I would remain still cautious on this whole situation.
We've seen a massive kind of relief rally in equities. Is the market now pricing in, a total resolution, or is it just pricing out that kind of immediate war premium?
Well, again, markets have been complacent across this whole thing, given that, let me give you just another number. In 1973, the energy shock has affected only 7% of oil and gas exports. Today, it's affecting 20% of oil and gas exports, just to give you the scale of our current energy shock. So markets today are not pricing in the potential comeback of inflation, the potential interest rates that will remain high, central banks will not be dropping rates anytime soon, and again, total resolution of the current war, which is, again, I take it cautiously. So yes, there's a lot of cash on the sidelines waiting, and they pulled the trigger as soon as the ceasefire was announced, even though there's no agreement, there's no signed agreement yet. So this complacency, again, we have to take it cautiously.
We're expecting energy to begin to benefit, assuming we see a resolution in the tensions. But what other sectors tend to benefit the most when geopolitical tensions ease?
So when political tensions ease, basically, all of this cash sitting on the sidelines will go to the sectors, or the obvious sector that benefits from an energy shock, and it's energy companies by far. I cannot even mention the closest sector that could benefit as much as the energy sector. The second sector that could benefit is a sector that I do not personally invest in, and it's a sector I don't like at all, which is the defense sector. Because usually post-wars, we see all of the countries involved in these wars, even first-hand or second-hand, they start arming themselves. It's the knee-jerk reaction of most post-war phases that we've seen. So the defense sector tends to benefit, and we're seeing quite a few defense companies having their stocks rise quite substantially.
What's interesting to me is that gold hasn't dropped as sharply as oil. It's around about the 4,700, 4,800 mark at the moment. So if the market's so relieved, what is it about the kind of the safe haven or the fear asset that gold is known as that it's still holding its ground?
Gold is no longer the fear asset. Today, gold is becoming very slowly the reserve currency of the world. So the rise in gold to $5,600 before the war was coming thanks to four buyers. Let me break it down for you. It's four layers of buying. The first layer are the BRICS central banks: China, India, South Africa, etc. They started buying gold 15 years ago and started building this gold position and reducing their US dollar reserve exposure. The second layer are institutional investors. The third layer is basically ETFs, individuals who are buying gold ETFs. And the fourth layer are speculators. So this buying of gold has been systematic and consistent on a monthly basis for the first two layers: central banks, institutional clients. These have not changed. They're still buying today, though we've seen a bit of sales like the Turkish central bank, but it's very, very marginal. So all of the reasons that pushed gold prices up before the war are still in place. And this is why we're seeing gold today at $4,800. If you look at gold prices over 3 months, 6 months, 12 months, 2 years, 3 years, and 5 years, gold has beaten the S&P 500 systematically on these periods. So gold today is transforming world reserves, basically.
Let me ask you a little bit about central banks. They're still so focused on inflation for obvious reasons, but how much do oil prices factor into the next decisions that we may see from policymakers? Because with energy-led inflation kind of suddenly cooling, we hope, does this give the Fed or the central bank here in the UAE, for example, more room for rate cuts perhaps in the second quarter, or is the inflation, baked in?
So let me break down inflation. You have two types of inflation: the demand pull and the cost push, the supply side. So when inflation is coming because of very increased demand for products, this is easy to handle. This is when central banks basically increase rates, they control demand, reduce demand, and this is when inflation drops relatively quickly. When is it the problem? The problem arises when inflation is coming from the supply side, and this is very difficult for central banks to fight, and this is why inflation has been sticky across the past 3 years. So oil is something that will affect supply. So when we buy products, these products will be higher because suppliers and manufacturers are charging higher because their cost base is higher. And this is very difficult for central banks to control and manage. And this is why today the stagflation scenario is the prevailing one. And in the case of stagflation, central banks do not reduce rates, because I prefer to have inflation to a certain extent rather than economic destruction.
You work with ultra high net worth individuals at Neovision. Are they buying the dip in oil? Are they moving capital into tech stocks, travel stocks? What's the conversation been like in the last 24 hours? What do you anticipate going forwards?
So, unlike common belief, ultra high net worth investors do not go buying the dip on Nvidia and the Nasdaq. They basically look for wealth preservation, and today wealth preservation is whatever protects them from inflation and from potential tail events, what we call tail events, or black swans, commonly known as black swans. So they did buy the dip on gold. Absolutely, I can confirm that. They did diversify from a currency perspective. So they bought, for example, Swiss franc risk assets, specifically Swiss stocks, because they are very good at wealth preservation. And more importantly, hard assets, real estate, things that preserve value and that can protect wealth. So no, they haven't been buying the dip on tech stocks and similar stocks.
Let's come back to the UAE. It's been a tense time. It's also proved to be a period when, once again, the UAE's been remarkably resilient, I think. That's certainly been the word that we've used the most in the last 5 weeks or so. To what extent do you think the ceasefire proves that the UAE is kind of the ultimate, macro hedge? It's a place where business can continue even when, neighbors are in crisis.
To be honest with you, I've been in the UAE since 2008. I've lived the 2008 crisis, to 2012, 2015, 2018. All of these news and newspapers. Dubai is over. Dubai is gone, and the UAE has proven again and again that no, the UAE is here to stay. The UAE is a Singapore. The UAE is a Luxembourg. The UAE is a Switzerland. The UAE is a Hong Kong. So I'm moving on. I'm not going to say anything about the UAE being resilient anymore because it's a de facto, it's a fact. So no one debates anymore whether Singapore is resilient. No one debates whether Singapore or Luxembourg are resilient. I'm beyond that. It's a subject I do not discuss anymore because yes, the UAE is here to stay regardless of the crises.
Okay, so that's put to bed once and for all. Looking at the rest of 2026, what's your kind of base case for oil and gas prices if the ceasefire holds? Your belief is around about the 120 level, probably? Between the 80 and 120 level?
In my opinion, it will wobble between $80 and $120. Right. And if you would like a better indication whether it's at $80 or $120, there's one account you could follow on Truth Social, and it's for President Trump's. You can go there. I have another window here on my PC, which I check live, and this is what tells me whether it's going to be $80 or $120.
That's the man that moves the markets for sure. For long-term investors, does this moment change the sort of broader energy investment story, or is the structural demand outlook the same as it was?
That's a very good question. It's a multifaceted question. First of all, yes, the whole situation today has changed the perception and the strategy of most investors around the world, how they want to invest. This has reshuffled the whole card table. Okay. From a demand perspective, I suspect demand will not be as high as before. So the United States, for example, has become self-sufficient and now has a wonderful access to reserves in Venezuela. So that demand, we do not feel it. The world doesn't feel it anymore. The second biggest demand was China's. And China today is very much diversifying its energy into multiple sources. So solar, water, wind, etc., nuclear. So I suspect that the demand from China, knowing that China's economy is not growing at 8 and 10% anymore, it's going growing in the 4 or 5% area. The demand from China will not be rising as we've seen it before. I think it will plateau over time. So the demand side will not be as resilient, as strong as before. So yes, this is reshuffling the whole card table.
Final question for you, Ryan. What's your overall thinking and your advice right now for investors? Is it time to be, how would you characterize it? Is it a measured time? Should you be aggressive? Should you be agile? What would you say?
Focus on wealth preservation rather than easy wins and speculation. The current war has burned many investors I personally know. They've been margin called, they had to sell gold, they had to sell very safe assets to cover their margins on risky assets. Looking at US stocks and AI, yes, it looks attractive on paper, but let's not forget that the United States is adding $1 trillion of debt every 180 days. The US debt today stands at $39 trillion. Deficit is $2 trillion. So the demand for treasuries, which is lending the US, is dropping. So this will affect this whole sector. And this is a very important factor to consider, which brings me to sovereign debt across the world. Today, wealth preservation is very, very important. And the regularity of investments. Gold, as an example, is not something I throw at it $100,000 in one go or $1 million. Gold is something I buy like a saving on a monthly basis or quarterly basis, where I build up resilient assets that help me preserve wealth. So if I had an advice to say, today, where we're living, wealth preservation should be the primary goal of any investor.
We've used the word resilient a few times. I'm glad to know. It's been good to talk to you, Ryan. Ryan Lamont is the founder, CEO of Neovision Wealth Management. Thank you for joining us at Mira Business FM.
Thank you. Thank you for having me, Tim.
Good to have you with us this morning. Thank you very much, sir. This is The Morning Drive, and it is Mira Business FM.